Jeff, how are you? Very good to see you. I'm so glad we have a chance to talk today because things have been busy in the market. So, we're going to talk about three financial planning and investment opportunities in a down market. So, recently, the US stock market saw its biggest 2-day wipeout in history, $6.6 trillion. Of course, things are still very volatile. Before we get into how to take advantage of it, I do want to talk through what we're seeing right now, which is concentration risk. 80% of the market's movements due to only 10 stocks. To put that in a different way, here's a look at the S&P's 3-month performance. The Mag 7 at one point had lost $2 trillion. So, Jeff, what should we keep in mind when we see this much red on the board?
That's right. The S&P 500 really had a stellar 2024, and it was primarily due to a handful of these technology stocks. Apple and Amazon, Alphabet, Microsoft, Meta, NVIDIA. These technology stocks really caused the market to soar, but it does create this big concentration risk. And so as people are getting closer to retirement or they're in retirement, we want to manage that risk as much as possible. That's why it's important to have a investment strategy that's very tailored to your specific needs, to your risk profile, to your goals and your wants, and when you're likely to be using the funds in retirement as well. And again, that's how we can control or reduce some of that concentration risk.
Yeah, that makes sense. All right, so now let's get into those strategies then. Number one, put your cash to work. I think a lot of us assume or we feel better hiding all of our cash under the mattress right now, but that really does compromise your ability to build wealth over time. Just to put that, to see what that looks like, that top blue mountain, this is the S&P 500. The middle blue line, that's bonds. And that black line, that's T-bills, which is essentially cash. It's a flat line.
That's right. Most advisors would recommend having an adequate emergency cash reserve, and they mostly define that as 3 to 6 months of expenses. And if you've got a lot of cash stashed away beyond that, you're giving up potential long-term returns. You're not going to keep pace with inflation, and so it's important to invest those funds. And when the market dips, that can be great opportunities. Also, there is the emotional aspect of investing that you have to consider. The emotions would dictate just the opposite of what you should be doing in the markets. When the markets dip, when the markets go down, people will say, I want to pull out. I don't want to lose any more when the markets go down. And that causes you to sell at a low point and lose money. When the markets go back up again, there's this euphoria that can cause you to want to jump back in the markets at just the wrong time. And so it's important to have an investment strategy to keep emotions to the side and also give you the opportunity to take advantage when the market drops, where you have the opportunity to buy in at a lower price point.
Right. That's a good point. Yeah. When we have that financial plan, then we're not making those knee-jerk reactions to the movements in the market. All right. The second strategy you suggest is called tax loss harvesting. How does this work?
So when you have money in an after-tax account, such as a joint account or a non-retirement account, a trust account, an individual, you have a cost basis to purchase that stock or mutual fund. And if you sell that, you could have a capital gain if it's gone up in value or a capital loss. So the tax harvesting strategy would allow us to sell those losers, the ones that haven't done well, and take advantage of that loss to offset other capital gains or to diversify your portfolio. So we want to look for good opportunities to take advantage of this. And the tax loss harvest certainly makes sense.
And then last, can you explain why Roth conversions make more sense in a down market?
That's right. When you convert from an IRA to a Roth account, you pay taxes all up front. So if you've converted $10,000 from your IRA to your Roth, you're going to pay taxes on that up front. And there's great long-term benefits to doing that. So in a down market, if you own shares in a mutual fund and you own those same shares, but the value of them has gone down, that allows you to do a conversion at a lower price point. That means you're going to pay less taxes on that conversion than if you converted when the market was really high. So when life gives you lemons, you want to try and make lemonade. And so when the market drops, that can create some good strategic opportunities to take advantage of.
Yeah, it's so nice to talk this through with you, Jeff, and recognize that there are some silver linings to our depreciated portfolios. If somebody wants to talk through these strategies with you, what's the best way to get a hold of you?
They can reach us at our phone number, 405-681-9633, or our website, gortonfinancial.com. And we're glad to help develop that plan so that they can have,
Right.
again, the optimal retirement strategy.
So important. Jeff, thank you.
All right. Thank you, Erin.